Hello, everyone. Thursday, February 23. Yeah, I got that right. Um, Great room and store. Dave Nicoski, who's no stranger to these rooms, longtime shrewd observer of markets, proprietor of Vermilion Research, will be with us today, sharing his wisdom. And we're at a crossroads in markets, so I thought it was a very timely, timely for Dave to be willing to speak. Before we get started, as is our custom, quickly, this day in history. I really like looking this stuff up in preparation for these rooms. It's reminds me of how much I've forgotten. 1836, during the Texas War for Independence, Mexico began a siege of the Alamo, which was captured just after 13 days, and for Texans became a symbol of heroic resistance. 1836, my gosh, the Alamo siege of the Alamo begins. 1868. President Andrew Johnson was impeached. The House of Representatives voted 126 to 47 to impeach President Johnson, whose lenient Reconstructionist policies regarding the South after the Civil War angered radical Republicans in Congress. And then finally, on a different note, in 1955, the co-founder of Apple, Steve Jobs, was born. 1955. So I guess what, that would make him 68 today if he was still alive. So with that, let's get to the matter at hand. Dave, good to see you. How you been?
Hey, great to be here, George. I'm doing good. We're going to be bailing out of a pretty heavy snowstorm here after tonight, so I'll have better news for you tomorrow on how I'm
There
doing.
you go.
So
I'm just curious, what is what is going on up there? I get. Wait, I got to be careful here. I know it's Wisconsin, Green Bay Packers, the legendary frozen tundra, but you have frozen tundra up there anyway. What's how's the winter gone this year? Has it been relatively mild, or you got a lot of snow? What's the weather been like?
we had quite a bit of snow earlier in the year, and then it somewhat dissipated for a good month and a half or so, where we didn't get anything. And I know Minneapolis got hit, really hard, 20 plus inches in many parts of the, Twin Cities there. We are not expected to get that much. We're probably going to be looking at close to, anywhere from 9 to 12 inches
Not
here.
that much. Spoken as a true Minnesotan. For those of us elsewhere, I think we would view 9 to 12 inches as a fair bit. At any rate, let's get on with it. A lot of interesting things going on in the market. I know you spoke in the space the other day, but the floor is yours, and maybe just give your sort of overview and sort of what are your most closely held convictions. So take it away, Dave.
Yeah. Our view is that we'd come up into that, 4165 area and pause at a minimum. I think my views going forward, I've shared on a number of spaces. What would make me, and as I tell rooms often, I'm neither bull nor bear. I look for opportunities where they exist in terms of, within sectors, in terms of groups and individual stocks. I look at the market from a top down and a bottom up basis. There's been much to do in the market. It's not, as bad as what we would think should look like at this part of the cycle by any means. However, the process of going through a business cycle is not such that you can just wake up one day and say, "Hey, we're going into a recession. Let's all bet on the recession." I'm surprised that the Fed has raised this much, and we're still, you know, coming up and making up terms like no landing, and it's the business cycle is what the business cycle is. It repeats after time, and until we start getting bankruptcies and companies going away, that's the normal business cycle. So without pointing to we are going into recession or not, I'm finding opportunity out there. I think the market and the cross currents that we're seeing right now is making it that much more difficult, in terms of looking at what interest rate hikes are going to look like. bond markets are telling us something different than the equity markets are. And that can only go on for so long. I think we are in a period where we have a generation of investors that don't know what a business cycle looks like. So any company that lowers guidance and then beats that lowered guidance, it's euphoria. It's like they don't want to let it die. They just want to continue marching on like it's Mardi Gras. Looking at the overall market, there's three things that I'm weighing, my decisions on when I'm, coming up with, just a few things for the average investor to look at, and that's high yield, bond spreads, which have been moving up here. I won't get the reading until tonight after my system updates the prices, but just over the last 6 days, we've seen that spike up and break a downtrend, which to me would suggest that it could go higher. So it'll be interesting to watch how bonds do over the next week or two. The other item. So I had three items. One, that was the first one. The second one would be how the banks look technically to me, and I've notated in the past several months that KRE came back to a support level, bounced off of it, started to reverse the downtrend, but couldn't quite clear the last hurdle, which was the former high. Um, it's pulling back to the 200-day. It dipped through it earlier today and then reversed back up above it. So I'm looking at the banks. I've never seen a good market with the banks, tumbling or hitting 26-week price and relative strength low. So that's a great, area to watch, because I think that's going to tell you what the lending market is doing. And if we don't have lending, that is how everything runs. It's credit. So if we see those that tighten, I think that would be very detrimental to the market. The third thing is, what are small caps doing versus large caps? Right now, this I look at the Russell 2000 and the micro caps. The IWC is a good proxy, and IWM. We're just marching sideways. So it's not such that I can say small caps are leading distinctively versus the large caps, or that they're breaking down. They're just moving sideways together on a relative basis. So I need to see that march above and start taking over leadership, because I don't recall a market where small caps didn't lead coming out. So I think there's a great deal of euphoria that small caps are leading or not breaking down. Again, we could be in a sideways market, and I think the typical investor looks at everything as being up or down, and I think it's going to be more sideways and more U-shaped in duration. I think rates are going to stay higher longer. I think that based upon what the market is doing and how the tape action looks, and I don't know if it's an ODTE type of thing, but it would seem like the Fed could raise 100 basis points and this market wouldn't go down. You
Dave,
know,
on that point, have you been surprised? I certainly have, and everyone's aware I haven't done particularly well of late, but I've been surprised that the market's been so resilient in the face of significant increase in interest rates up and down the curve. Have you? What's your view of that? Are you similarly surprised, or does that tell you the market? Is that indicative of something else going on? Some underlying strength?
well, I think it denotes that we've had years and years of zero interest rate policy, and I think that it's pushed liquidity and savings up considerably. And I don't look at a savings chart, but for this market to hold up under the pressures that are being exerted on it, um, I think it's very unusual, relative to history. What is different is we're not seeing job losses like we've seen in other cycles, and I do believe that we will get job losses, and that's where the Fed needs to push us. And again, that's through time. And me calling it today, someone's going to come up to me, 2 months later, say you were wrong. I see so many people come into the Twitter rooms, and if someone comes up with a prognosis of what the market was going to look like, a year ago, you get belittled, you get shot down, and it doesn't mean they're wrong. They're just saying what their longer term picture is, and the process will play out over time. And again, that is the only thing that ever heals a bear market. And arguably, we could discuss whether we're in a bear market or not, right? Based upon the tape, you wouldn't notice a bear market considering that we had the biggest bear market in bonds that we've ever seen ever. So arguably the equity markets have held up very well, relative to what we see in bonds.
Yeah, I've been reading up on that, and some were suggesting that as opposed to last year, where you had rising interest rates with growth expectations flat to down, that this year growth expectations, certainly outside the United States, specifically Europe, because largely because the energy costs have come down significantly, and also China with the reopening. Some are making the argument that equities can withstand higher rates more readily if growth expectations are increasing. And so I don't know, kind of made sense, but what do I know? Um, Dave, let me ask you this. I've been pouring through charts myself, trying to find things, go long, go short, whatever. And I saw a really interesting, I'm trying to find it here, really interesting chart today from Jim Bianco. And maybe you've seen some version of this or you have it yourself. But essentially, and this was, I think, as of yesterday, um, the 22nd, I believe the market was up. See if I got this right here. You've got 8 stocks: Fang plus MNT, Microsoft. Well, I don't know what it is. Facebook, Apple, Amazon, Netflix, Google, Microsoft, Nvidia, Tesla, the usual suspects. You have 8 stocks which accounted for 3.1 of the 3.8% year-to-date return, or 8 stocks accounting basically for 80% of the market return, suggesting this is in the S&P 500, and therefore the other 492 stocks not doing a whole heck of a lot. And so the action's really been kind of concentrated. Does that square with your observations?
Absolutely. And again, there are individual stocks that are doing much better than what the indexes would suggest. Take for example, I've been bullish of the tanker stock since last year, and I've thrown the tanker stock of our group work up on my profile a number of times and discussed them. You have like Frontline is breaking out to a 7-year price and relative strength high. Euronav, TK, NAT. I mean, I highlighted engineering and construction stocks and talked about them in probably August, September time frame. They've had huge, tremendous moves. If you looked at the S&P Mid Cap 400 Engineering and Construction Group, it's been on fire, hitting all time highs. And the problem is they're names that most people don't know of. There's a lot under the surface that are doing absolutely terrific. They're more mid cappy names out there that look the best, and they have the potential to move into the large cap arena, right? So it's and I try to tell people, even as far back as June and July, that there's a lot of consumer stocks that when they pulled back looked great, and my poster child for that was Crocs. Moved from 46 up to 135. There's individual stocks, and I think this is a stock picker's market more than anything, rather than a group move. But when I find the groups, I think it's important to highlight them and indicate that if you get in the right group, that's 70% of success in terms of being in the right group. And so I like to see group moves much more than I like to see individual stock moves. But again, doing it from a top down and a bottom up approach, I think you weed through them and find those
Got it.
names.
So let's talk about groups and sectors. Does anything stand out to you, conspicuously good or bad?
Um, Banks are probably the most troublesome for me on a relative basis. I don't like to see the banks doing nothing, and they pretty much are doing nothing on a relative strength basis. They're underperforming the overall market, but they're not hitting relative strength lows across the board. Um, I like to see a healthy financial sector, because it does reflect concerns of the market and credit quality, how much credit there is in the system, and it's going to start reflecting defaults at some point in time. We were discussing on a call yesterday. I think it was a PIMCO deal. Most of you probably saw this. They defaulted on a loan. I think it was 1.7 or 1.8 billion dollars. They had purchased the property, I believe, in March of 21, for like $3.2 billion, and it was a number of properties: San Francisco, New Jersey, and a few other cities. But the commercial real estate market is, from listening to a number of calls and seeing research and articles that come across my desk, I think that's probably the biggest concern for me, that it doesn't have to be, like the global financial crisis where you have a ninja type loan, but it can happen from within, and just the change in how people are working and working from home versus, going to the office. It's not that the owners that or purchased those properties didn't have good intentions and didn't pay the right price, but I think the whole aspect of how COVID has changed the dynamics on how individuals work from home. I don't think anyone could have seen that. That's the black swan event,
So,
for those people that buy commercial real
so Dave,
estate.
if I understand you correctly, it's not the banks are acting so badly; they're just not doing anything. Is that fair? I want to make sure I understood what you were saying.
Yes, that is
Okay,
correct.
so we can't really say you're bearish in the banks. They're just kind of like neither fish nor fowl. They're neither here nor there. Okay. Um, Moving on to other sectors. Anything catch your eye? I mean, technology's been performing well. Energy, despite expectations, would do well. And I know you were correctly bullish on energy. And I think recently kind of took the flag down on that. So maybe just speak a little bit to your views on technology and energy.
Yeah, we've taken down our weighting on energy, from a relative strength basis. I often get asked when about that. Is it based on earnings and our expectations of what oil is going to do? I'm a relative strength guy. I can't tell you what oil prices are going to do, but when they're bringing down the sector and you're losing relative performance in the names, they can stay cheap for a long time, just like they have. And the question is when does the world wake up and realize that paying 50 or 60 times earnings on a tech company, when it doesn't hit those numbers, then you're going to want to own the names that are cash flow positive. In energy, we've been, I marked up a chart and it's on my timeline. If you look back in October, for instance, I suggested that moving money into oil service names is a much better place. It's far outperformed the XLE. So OIH versus XLE, you had about a 30% performance variance between OIH and XLE over since October. That's starting to, pull back a little bit. I don't see any tremendous breaks in it, but I would rather be in oil service names over the E&Ps. Um, the next sector, if you look at materials, I'll just go through some of the sectors and hit on some points. Okay, George.
That'd be great.
Um, Steel, a lot of the steel names like Commercial Metal, Steel Dynamics, and a plethora of other ones, not necessarily saying Cleveland Cliffs or U.S. Steel, but you take Carpenter Technologies has done very well. ATI, Worthington, um, some of the foreign ones, Ternium, which is I think that's Argentina, Steel Dynamics, Ryerson, Reliance Steel, and aluminum. These are in solid bull markets. POSCO, which is South Korea, Nucor, have done extremely well, and we continue to believe that those are still locked in bull market uptrends.
Right. Um, Moving
Uh,
along to some of
yeah,
the other maybe commodity related things. You mentioned steel, but how about I don't know, copper stocks or
copper is still bullish. I don't see any issues in copper. Copper, we always look at that as kind of the you know uh, industrial complex. Manufacturing's held up very well. We upgraded industrial manufacturing. I believe it was October 12th of last year. We're still overweight on it. I'm starting to see, at least on a relative strength basis, some of those pull back in. But overall, we're still overweighted in it, and I continue to like a lot of individual names that remain, in bullish chart formations, big bases, breaking out of bases, that type of
Right.
thing.
How about related to that, commodities? What about I don't know, the bond market or interest rates? What's that look like to you?
Well, we highlighted in our work that you broke those downtrends in the longer duration, as well as broke out to a new high in the 1 year, and even on the short end. And I think that's what precipitated the market's pullback. We were unable to uh, you know decisively push to new highs. As a matter of fact, if you're looking at a candle chart, you'd see high wicks on the upside, and you could never take those levels out. So I think that bonds are telling us, you know, higher and longer, and we're going to keep getting the, Fed futures are going to keep migrating up, in my opinion, especially with what we're seeing in the overall market, that we're not seeing what we should expect at this point in the cycle.
Got it. Um, we didn't talk about consumer stocks. I know it's a very heterogeneous group. Any thoughts there?
Yeah, it's been an area that we have liked, and I've discussed this on, when you take a look at something like RCD, which is the consumer discretionary equal weight. I mean, that's decisively in a bull market, so the average stock is doing much better than the large cap, and that made its a low back in June, and then made a subsequent low back in October. So you did have a double bottom.
Yeah,
um, Again,
Dave, just for
finding,
everyone at home, what
yeah,
is that ticker symbol? RCB or RCD? Okay,
RCD, Roger
and that's
Charlie
the equal
David.
weighted consumer stock index. Okay,
That
right.
is
Okay,
correct.
and so that's telling you everything is okay given the way that's been acting.
Yeah, I mean, you're pulling back to an area of support here because after you got the retail numbers, you had a large pop and have pulled back in. The XRT is, if you pulled the XRT or XLY, um, XLY is going to be your consumer discretionary. XRT is going to be your retail stocks. That one's starting to um, show a pullback in it. I think that I would look for individual names in there, versus trying to make a call on the whole sector. You look at something like, I like the restaurants, but I can't make a blanket statement like that, because if you looked at Domino's today, that's got to be an ugly chart for quite some time, and I think it was down $42 today.
Right.
So it's very difficult to come out and make a broad based blanket statement on certain areas within the market. It's much easier to say, here's an example of what I'm saying. So, if I went through and discussed something like Brinkers, or, there's Texas Roadhouse, Wingstop, they're completely different charts than what you would see in Domino's. Brinkers got a great looking chart. Um, Gorgeous base. You're coming up to some resistance, but I don't see that it's an issue. Trading at 12 times,
Sure.
it's relatively cheap to the rest of
Got
the
it.
market.
That makes a lot of sense. Hey, let me ask you this. I mean, life is not linear. The opportunity sets expand and contract. Sometimes, to use the baseball analogy, Mr. Market's giving you a lot of pitches to hit. Other times, not so much. Um, how would you characterize the opportunity set right now?
Uh, You know, unfortunately, I'm a technician, and I can say, hey, this trend is intact and it's not intact, but I also believe that valuations play an important role. I think fundamental analysts make the charts for me. Okay. Um, and even if someone's bearish and you get a good bullish chart, it's a good sign to dig into the fundamental story and see where the analyst may be wrong. So I like when they both match, and I guess my opinion is typically technicals will turn. I will be able to call tops and bottoms faster than the fundamental analyst, in my opinion. That's my experience of doing this for 36 years. Right when selling stops, that is what makes a bottom. It's not necessarily that the fundamentals have changed. It may be discounting something in the future that many fundamental analysts may not pick up. So I guess I'm going to adhere to the charts look great. I'm fearful that we haven't completed the business cycle. We haven't seen defaults. We haven't seen job layoffs increase. I think the Fed's on a one-way trip to get to do that. Despite their dual mandate, they have to drop one of them to get the other one in control. And I think that is the path that we are going.
Got it. Are you okay? So here we go. Hold on. We have someone who. Okay, excellent. Hey, Carpathia, welcome. Good to see you. I was going to ask another question, but I don't want to monopolize things. So, good to see you, Carpathia. What's on your?
Well, I mean, I don't really have much to say. Dave is pretty accurately describing this. I have my little world in my family office and my little reach. And, I think it's really easy to make a mistake here. And I think Dave said this, the conflict between the bond market and the equity markets. It's like the equity markets don't want to acknowledge that there's now a hurdle rate. And in my little world, 3 people in the last 2 weeks, or I talked to prospects, some clients, unsolicited said, hey, I'm thinking about going 50% to a 4.5% yield. What would you recommend? I'm 66, got a couple $1,000,000. So it's seeping into, that dynamic out there. I know the institutions and the systematic passive that I always say dominate, but I believe it's starting to sink in to the general mom and pop investor a little bit. I was telling the spaces last night, I've been cheating a little bit on some of these go-go space calls that I was run off in 2021, and I was publishing, as you know, George. I was like, okay, as we go through 21, everybody, take a little more off the table, take a little more off the table on risk management. And then, in early 22, like, hit the fire alarm, get out, heavy percentages. So I was listening to that call, and they're talking about buying dividends and what they consider safe and, buy Google because we know it's going to go back to the high, and in 3 years you're going to get 20% a year. So it is, it's not, it's totally just incidental, but the tone's changed a little bit. People have had their knuckles wrapped a little bit, but they haven't really given up. So I think we're at the mercy of this psychology that's beaten everybody over the head, not the institutions, but beating them over the head. If you change your strategy, you're going to really screw up. And that is like the equity market, the poster child of the equity market saying, well, don't look over there. Don't look over there. Just walk on by. Don't look at that 5% yielder that won't go down and protect you. But I think that's the stress in the market. I put a piece out today to my private group. I said, Walt Deemer's really good. The BAM, the momentum index, it has a high record, and we got to respect that. But we also have to respect the business cycle that Vermilion, that Dave's talking about. So what I've elected to do, is we're going to play it safe. We're going to keep high cash balances. We're going to keep our little squirrely out of the way securities and ETFs. We're going to have a high position in precious metals, which has been down and straight down for 5 weeks. But we're gonna wait for the Copic guide to turn and just play it safe and see what we do right here as as the next 2 quarters come in. I think higher for longer, and I think we're just going to have to ride this thing and see if those job losses. Who was it? There, he's on this call. He's on the call today, but he was saying making a theory that we're not going to even get close to the pivot button until you see, was it, you know, two negative job losses or six-figure negative job losses global. Maybe you could jump up and global macro and fix. If that happens, it's going to be this giant tug of war. And, you know, that's the way I'm setting up for. I think it's easier to make a mistake, and I'd much rather, you know, sniper shoot some of Dave's ideas and some of my ideas and just, you know, go that way. So that's my 2 cents. I think I think people have gotten a little bit of religion, but they're running to what the textbook says. Okay, I want dividends, and I'm going to get dividends. I'm going to be safe now, but you know, maybe when 25% of the market going up is those 7, 8 names, you know, maybe that's not the place to go. So that's the only thing I have. I wasn't really prepared to speak, but
That's
I
great.
thought I can come up with something.
Yeah, I appreciate Carpathia. It's very thought provoking. Um, okay, let's move over now to Cyril Japon. Good to see you. How you been? What's on your mind?
Hi, thank you for letting me speak. Just a very short comment. I'm a moderator at a very small site, like 200 people, I guess, and we are mostly students and very, very small young investors. The thing is that we are discussing bonds now and yields. We never did it before, and the majority of people in this forum have been in meme stocks and most popular stocks, and they are now looking into bonds and yields and safer things. So that does it tell you anything about changing psychology or not? Thank you.
That's really interesting. Really interesting. I think it gets to Carpathia's point about once you get wrapped on the knuckles, it has a way of changing one's outlook. So yeah, no, that's a really interesting observation. Uh, that's thanks for that. That's great. Okay, let's go over now to Liberty. Liberty, floor is yours. What's up? I don't know. I've lost the matrix. You can't hear us. So Dave, hopefully Liberty will speak up at some point. So Dave, as you speak to clients, a lot of times one can form conclusions or from discussions with clients and interesting observations, not just what's asked, but sometimes it's more interesting what's not asked. How would you describe the investor mindset right now, Dave?
I would say it's a lot of confusion. A lot of people think it's very fast sector rotations. I mean, historically, you get into um, periods where a sector can lead for a long period of time, like energy led for a year, actually almost 2 years. If you went back to January of 20, that's when we came out with our secular bull call on energy. And I'm going to have to say, I don't think that that's necessarily over. I think we're suffering a cyclical correction in a secular bull in it. But we have to pull back, when we see relative strength changes. And so, even looking, at commodities today, I would say most of them are bottoming when it comes to the metals. You're seeing, the bulk tankers. I threw out a chart of sea bulk today on my timeline, and I have a list of them. I only throw out a couple, and share everything with my clients, of course. But when you look at something like that, and you're breaking out of a base, and everyone's paying attention to Nvidia today. It's they want to go to the shiny object, and sometimes going to the shiny object is that it's shiny one day and it's not shiny the next day. And I think if unless you're a day trader and can jump in and out, that's great. But I also think that these ODT options are screwing the market up from actually going through the cycle, because they're just buying at the bottom of the range. They'll play it to the top, and I can't quantify it, but the market is not, in my opinion, behaving in a manner that I've seen throughout history. um, but I put up a chart and threw it on my timeline today as well. Sorry, I keep saying things like that, but Midwest hot rolled cold steel was up 22%. I don't know if it switched to a new contract today, but that's a pretty big move in a metal in one day. I not You can look at the chart; you won't see many moves like
Wow.
that.
So is that is that updated regularly? That's an extraordinary move.
Yes, it's updated regularly, but it's up 22.24%
Wow.
today. Yeah, I didn't hear anyone talk about it, but I think it was a contract roll, and I think Cleveland Cliffs came out, last week or 2 weeks ago, said they were increasing their prices. But I think that when it comes to shipping, especially with what's happened to Russia, you're seeing Russia purchase a lot of tankers to get their own crude out there, since no one can insure them. So you have this, so many countries import raw materials. You've changed all the supply lines, and you're shipping longer distances as well. So that's part of the prospect, as well as I think through this last downturn from 19 through the end of 20, there was, I think, 300 tankers that were sold for scrap steel. And I create the analogy, if you look back at that 98 to 2002 period, there was 500 tankers that were sold for scrap steel, and you went into a secular bull market in tankers, from end of 2002 to 2009. It takes years to build these ships, and most of the shipyards don't want to build them because they got screwed on the last, major cycle, where they all of a sudden, no one wanted to take delivery at the top. So they got stuck with these ships, and they literally cut them right apart after building them, because the companies were, seeing day rates drop. So I think that's a longer cycle. But that's the one area that I see, and I'm not trying to push it because I own it or don't own it. It's something I've been highlighting for a while.
Again, just to remind everyone, it's not investment advice. This is just
Exactly.
Dave sharing his 2 cents. By the way, since you brought it up, the shiny object du jour, Nvidia. What does Nvidia look like to you?
I mean, it actually, I'm going to say it somewhat surprised me, because all indications on the chart were, that you were starting to roll over. You started taking out, some minor support levels. You gapped up. Now you got this big open gap, and you're above, a resistance level. So from a technical standpoint, it's very intriguing. I just can't pay $25 for 8 cent beat on lowered guidance that had been lowered previously. But it's intriguing. And they said, what, AI? I guess you can say AI. We should talk about AI in this room. It might fill up, and we might break Twitter if we do that. But it seems that's the new buzzword, kind of like the adding .com to your name in 1999. That's what it feels like. But
Hey, Dave, I forgot to
so
mention I'm AI adding to the Carpathia. So just for everyone,
yeah,
we're going to add AI.
That's great.
I'm thinking about changing our company name to
There
AI
you
as
go.
well.
All right, so we've got three folks wanting to speak. I'm going to go to Michael first because he was up, then he dropped off. We're going to do Michael, the Carter, and then Liberty. Michael, good to see you. What's on your mind?
Great to see you, George. As usual, it's an amazing space. I learned so much from these spaces that you held. We're very lucky to have you. Couple of things. Firstly, NVIDIA. How correlated chart-wise is it to the movement in Bitcoin? Because that's basically the chips and everything that are needed to move that. That would be my first question.
So I guess you're wondering how about the relationship and the correlation between Nvidia and Bitcoin. So
Exactly.
yeah, so Dave, I don't
A
know.
gyration.
Dave, you have a view on Bitcoin, and do you have any thoughts about the correlation question?
Well, technically Bitcoin looks attractive. I don't like to talk about Bitcoin. I don't get it. But I mean, if you took a Bitcoin and ran Nvidia against it, I would tell you, hands down, Nvidia has been beating the hell out of Bitcoin. I mean, just in the last year, um, Nvidia is up 41% relative to Bitcoin.
That's good stuff.
Yeah, and I brought this up in a room yesterday. As much attention that's paid to Tesla. Here's and some of you that might have been in that room yesterday may have heard this, but if I asked you what has outperformed between these two stocks since January of 21, Tesla or Stellantis?
Mm-hmm.
How many think it's Tesla?
Of course,
Right.
we all would say it's Tesla.
Yeah.
Yeah, right. Stellantis is up 50% relative to Tesla since
Wow.
that time
This is
period.
what, from the beginning of 21, you're saying?
I want to say it's from. Hold on, I've got to pull the chart back up. I just erased it. This is from the beginning of 21.
Wow, that's
Stellantis is up 50%
crazy.
relative wise. You would have been better off buying Stellantis in
Who would have
21.
thunk? Who would have thunk?
So,
Exactly.
so David, my second question, I appreciate, is the structure of the dollar, because look, I was short subprime in 2007 and getting my ass kicked for most of my 2006 to 2007, getting my ass kicked. And then finally, really everything was correlated to currency exchanges. As the yen strengthened, things completely fell apart. And right now, if the yen weakens and the dollar strengthens, things seem to fall apart tick for tick. So I don't know, from my own TA, I've seen that the dollar has actually broken out here, which to me is eerily reminiscent of what happened in 2007, where everything was currency related. So have you done work on the dollar?
Yes, and we changed our position. We did call a dollar top, and it was literally like the day of or the day after, and I'm pretty sure it's on my timeline. Um, the my biggest fear here is looking at the 2000 bubble, and I don't know how this is going to play out, but I pose this and ask my own clients this question is after 2000, the dollar strengthened in the internet bubble, and it finally broke its uptrend in April of 2002. Realize that from the end of March of 2000 up through April of 2002, if you bought any old economy or value stock, you far outperformed the market, right?
There was a disparity
In
there.
April of 2002, we put a piece out that that we believe that we'd see a huge repatriation away from the dollar when it was breaking the uptrend, because it was vertical. It's very eerily similar to what we've seen here. And through that repatriation process of April 12th, if you look back at the S&P 500 or any index in the U.S., we absolutely went straight down. We did a triple bottom all the way up to December. And that's when the emerging markets started accelerating. That was the boom in, on a quiet night back in the early 2003, you could hear a sucking sound from the east. That was China sucking up everything.
Right.
Low commodity prices. So, my fear is that we could have that put upon us again, a repatriation. We've been seeing that repatriation. We've been seeing Japan selling the dollar. We've been seeing China selling treasury, Japan selling treasuries, and China. I think there is a move to repatriate funds back to, their home countries.
So are you constructive on the dollar or not?
I'm constructive on the dollar right now, but I'm fearful that we're just going to suffer a bear market rally with another subsequent decline.
But would you say that it's correlated, though, that if the dollar starts to gain strength, and let's say it breaks out and hits 106, it's going to cause incredible havoc in the stock market, right?
Absolutely.
Okay.
Absolutely.
Got it. Appreciate your time. I love these spaces, George. You should charge $20 a person.
We'll see. But so Dave, just run with that a little bit though. Building on what Michael was saying, I remember from way back when, I think it was something Stan Druckenmiller told me once. But if you have a rising dollar, well, actually, I'll take it back. It's pre-Stan Druckenmiller. I want to go back to Japan in the '80s. That you had the so-called triple merit scenario, You had falling interest rates, a rising yen, which kept capital bottled up in Japan, and you had and falling oil prices. So right now, if you think oil is sort of bottoming or flat to up, you think the dollar, at least for now, is going up. You think rates are going up. I mean, not to ask a leading question, but you know what the question is. Like, it doesn't sound like a very positive constellation of factors.
I think that what we have now is eerily similar to 87 when yields were rising. There was a huge disconnect with the equity markets and the bond market. And it plays out one way. It plays out
That's a
one way.
happy thought. That's a happy thought.
And I'm not trying, anyone that has known me in my career, I'm typically a bull. I mean, I always find something to do. I'm saying this is a proposition. I don't know how it's going to end up, but there's very similar aspects to post 2000 bubble, two years out, in 2002 April, and 87. You had yields rising, the equity markets were untouched, and you walked in one
Mm-hmm.
day and everything was gone, right? And I'm not saying we're going to get there, but there's, and I don't usually there's an event that creates it. And for example, and I've discussed this many times, most people don't know what pricked the 2000 bubble in March, and that was Tony Blair and Bill Clinton were at a podium in London the day of the top, and we put a piece out on it and said if it can happen to biotech, it can happen to tech. That was the day of the top in the NASDAQ. Okay. And that was Human Genome Sciences had just decoded the human genome. And Bill Clinton and Tony Blair both suggested that information should be shared freely with all healthcare companies. So, every private investor would have been screwed that helped fund the decoding of the human genome that would have been done in a few months from then. But that was the very top, the day of, and it happened within minutes after
Yeah,
that
I
speech.
remember it like it was yesterday. In
I do
particular,
too.
I was at the Morgan Stanley Tech and Telco conference in Midtown Manhattan. It was Nasdaq 5,000, and the market started down. It was down, I don't know, 200-300 points one day, and no one knew why. But that was you like to think when markets are similar, but also how they are different. At that point, there was the IPO activity was so outrageous. The amount of supply of paper was just extraordinary. And the thing is, when things get really overvalued and overcooked, Wall Street has an infinite ability to manufacture more paper, and the supply just sort of had the thing collapse on itself. So, yeah, but we don't have that dynamic. It's similar, but it's also interesting.
Well, we got SPACs,
Yeah,
right?
that's a couple of years ago. So yeah, so it's always interesting. They say history rhymes, doesn't repeat itself, and so it's fascinating point that you make, David. Appreciate that. All right, let's move over to the Carter. Good to see you, Carter. What's up, man? Haven't talked to you for a while.
Hey George, how are
All
you?
right, what's going on?
Yeah, I would go back to a space you did in I don't know if it was the Christmas Eve space or what, but I remember chatting then, just saying that everything was sort of in everything was sort of in train for the market to continue lower into the first quarter. But I said at the time, if I'm wrong, I'm just ultimately the market's going to go that much lower later on because, and you're seeing that play out because back in December, economic data was starting to turn lower, or it was moving lower, and you saw Fed fund futures coming down in line with that. And as we've seen data, for whatever reason, data has inflected in January. Credit card spending's up. That jobs report was a big inflection point, and I just think the bear case, while it looks dumb in January and into early February. I just think it's been bolstered this year. We can go into that, but just with that as backdrop, I love Dave's relative strength stuff. I'm a huge relative strength guy. I think that's the only way to look at sectors really. And I would say that So back in December, I think in that same space, we talked about the relative strength of the defensive sectors, and those charts they looked really good, but they right at the turn of the year they turned down in line with this pickup in the economy. But if you go back and look at how relative strength and the defensive sectors behaved in the early stages of the 2000 to 2002 bubble, you had pullbacks of 10 to 13% relative to the S&P. Excuse me. And that's exactly what we've seen year to date. So it's been painful for those of us who've been overweight those sectors where appropriate. But if you think a recession is needed to bring inflation down, I think this is an excellent spot to add money to defensive sectors.
Absolutely. And I put out charts last week, I think on Tuesday. You'll see them on my timeline of the XLU, XLP, and XLV, all breaking the relative strength. And I suggested the week before that, the relative strength downtrends on those were just parabolic down, like no one needs utilities or food or healthcare anymore.
Exactly.
And so I look at those during periods like this, and when I see them go parabolic down, it makes me fearful that everyone's piling into what's working. It's the shiny object that over here, let's not pay attention to that because it's not working. So at some point, you run out of selling pressure in those sectors, and you are seeing that, and that's what helped precipitated this little peak that we have.
And if you look at how those sectors behaved into that 2000 peak, that was parabolic down. That was a complete washout.
Yeah, if you look, you're right.
And you had staples, utilities, healthcare outperform the S&P by 80 to 120%, depending on the sector, into their relative strength peaks in 2002. We're just getting going with these things, and I think we're going to look back on January, February as a pretty epic time, just in awe. I think we're going to look back at it in awe. And yes, there's a ton of confusion out there. I work in the business. Everyone's confused. But if you look at the yield curve never confirmed this as a new bull market, still has yet to confirm. And you never got 90% of stocks over their 50-day moving average, which has marked the end of every single bear market going back to the 60s. So it's confusing, but if you can look beyond 0 DT option timeframes, it's pretty friggin' bearish looking out 6 to 18 months, I would say.
So Dave, I know you're big on relative strength, but if you had to hallucinate or project or forecast a little bit, you started to talk about shades of 87. I mean, how would you handicap that? You think? I mean, put it this way. I know you say it's a market of stocks, and if you want to take the fifth on this, that's fine. But if I always ask you, at the end of the year, do you think the market's higher or lower than it is right now, Dave?
I'm going to say by the end of the year, it's going to be flat. I think we're stuck in a trading range right now, but I do think that we will complete the business cycle somewhere in the next 6 to 7 months, and you're going to see some Fed cuts if we're continuing on this trajectory, and it may be early next year. I do think that we have. I went to Costco. Here's just to throw this out. I went to Costco yesterday. Once in a while I pick up muffins. I have guests coming over to my house this weekend to go snowmobiling. And I was going to pick some up, and I looked at the price, and I just picked them up a month ago. They were $6.99. They're now $9.99. I'm like, really, 40% price increase, or 30%? Like, I don't see prices coming down whatsoever on any needed goods like food. As I walk through the store, and I like to just browse around the aisles, and I see a lot of the durables are all marked down, sale, type of signs at Costco. But I don't think that you have as strong of economy. And I see Neely's in here, and I love chatting with her. And I posed this question to her the other day in a DM. How much, gift cards did we see sold during this last season? And I found several different ones. And I guess I'm in the camp that if you see restaurants up that much, but you don't see it in, Home Depot, I'm going to assume that, gift card sales for restaurants were pretty high, especially when you see, Walmart's numbers or Home Depot numbers. I'm just going to go with my gut and say I think that's something that, most people opted, instead of getting something for someone, get them a gift card for a restaurant or for a store. You look at Bath Body Works and Inner Perfumes, hey, perfect Christmas gifts, right? Stocks have done very well.
By the way, I
But
see Neely is in the room. It was great the other day when the two
yes,
of you were speaking. If she has the bandwidth, it'd be great for her to come up to share some wisdom. Cart, I want to come back to you in a minute, and Howard, we'll get to you as well. But Neely, this would be a great place for you to weigh in on, dispense with some of your consumer wisdom. Good to see you. What's going on, Neely?
Yeah, likewise. Nicoski and I have been talking a little bit about this gift card thing, and we're going to agree on a lot of things about which state to live in, Mr. Nicoski. But I actually think the bigger issue in January is the cost of living increase for being paid to the Social Security benefit payouts. 66 million recipients currently receiving Social Security benefit payouts. The average increase, which is up 8.7%, translates to about $216 per month. And it's not insignificant, to those payouts, overall. So, I mean, if you think about $216, that's, I don't know, is that 2-3 trips to Olive Garden? I never go. I have no idea. Is that, 10 trips to Chipotle? I mean, that's why I think we saw restaurants do what restaurants did in January, and that's going to be with us all year as a potential tailwind to consumption. I think that it's going to get challenged, right, as it's going to abate quite a bit, beginning handily with the SNAP benefits rolling over, the temporary increases rolling over in March 1. And that's going to affect, I think, like 44 million households. And then you start getting into the Medicaid access going away for another somewhere 14 to 17 million households, where they were essentially getting free healthcare. Now they won't. And then you get into the summer of student loans. Some people talk about the hot girl summer. I think it's going to be the, hot mess summer, right? For a lot of student loan borrowers. You've got SCOTUS listening to the student loan arguments actually next week, Tuesday. They won't deliver their opinion, we believe, until June. But, it's going down for real.
So, Neely, I just posted up on the Nest a point that you had raised the other day about the number of tax refunds. I thought that was a fascinating point, and I think for those that didn't hear you the other day, it bears repeating that the total number of refunds is just going through the roof, and it's less to do. It has to, I'll just paraphrase for you and let you have at it. But your tweet said total number of returns up 9%, total number of refunds up 48%. Total dollars refunded up 27%. So could you just elaborate on this a little bit? What's going on here? Because I thought it was a really brilliant point by yourself.
Sure, thanks. Yeah, we do watch we think for about 15 weeks out of the year, out of 52, what matters more than rates or CPI is actually tax refund season, and we're in the thick of it right now. We were only, when I made that tweet, that we're only 18% into the tax filing season. We'll get an update on that data very likely tomorrow. So that could narrow from the numbers that we posted there, just FYI. It's not me projecting, it's me responding to what the IRS data says. But, it does bear worth noting that in the first couple of weeks of February, you had 50% higher, it was actually 48, but 50% higher issued tax refunds. The average refund amount was down just low double digits, but we think that largely has to do with just the mix of the refunds. There were probably people who owed a little bit last year who were refunded a little bit this year, and that's cash in people's pockets. We would expect retail sales with the cost of living increases, as well as with some of these early tax refund statistics, we would expect that you're going to see kind of more expansion in retail sales relative to expectations. But again, it changes dramatically come March 1 with the SNAP benefits rollover. So it's a schizophrenic. I mean, I just worked on a client deck. We're doing a keynote next week, George. And, I've got this whole section I've never done before, ever in 26 and a half years, where I literally walk through the economic realities of consumption by month this year. Like, I've never had to do that. Usually it's like one thing you can kind of call out and talk about and throw a couple charts about and talk about your consumer realities, but in thematics. But like, no, I literally have like a chart or like a slide for every month, because that's how schizophrenic it's going to be for capacity to spend.
That's crazy. That's really crazy. So why don't you just hang there, Neely? I'm sure we'll have some more questions. Let's go to Howard. Howard, good to see you. What's going on, my friend?
Hey, George, great space, and David, really, really constructive stuff. And I actually, this question might be for you and for Neely. We'll put it to two Minnesotans. You mentioned commercial real estate being pressured, and we've seen, this was small, but I think it was yesterday that PIMCO defaulted on, a PIMCO subsidiary defaulted on loans on 7 buildings in San Francisco, New York, and Boston. I think Jersey City was the other city. We're starting to see hospitals unable to service their debt. I think the latest was Tufts Medicine, but there have been a couple other majors. And I'm wondering, both in commercial real estate, but also with corporate debt, as the Fed pushes rates up a couple more percent or tries to, what we're looking at there. And Neely, you might have some insight into a lot of the middle market debt and the EIDL question and so forth that you've been following. I'm just wondering if either of you have a particular view on how far this is going to go, or your current read. Thanks very much.
Go for it, Dave.
Come on, Neely. I wanted you to go first so I could tag off of you and adhere to something.
I'm more than happy to have you go for Howard's always excellent and difficult questions. Go for it.
Right. I think it's bigger than the one headline. You've seen some of the BlackRock discussion a month and a half ago. It's kind of like the Credit Suisse thing, and I threw it up on my timeline when everyone was talking about the potential for Credit Suisse to have problems, and I tweeted out, if this doesn't push clients away to check to see who their counterparty risk is, I don't know what would. I mean, literally, when you see headlines like that, everyone's going to remove themselves from having the counterparty risk. I was in a space a few months back, and a portfolio manager was talking about how they bought insurance in case Lehman fell apart. Except the contract was with Bear Stearns. Now you got Bear Stearns as counterparty risk in case they fail. So it becomes a house of cards. And I'm going to say if you're seeing something, it's more than likely it just reached that point on those particular properties. And I think that's going to be widespread. I know downtown Minneapolis, where my office is, if I walk through this, we have the Skyway. So if anyone's been to Minneapolis, we have the tunnels that you can, walk above the street. They're glass tunnels, go from building to building. I know, 4 years ago, I could walk through there and there's a restaurant, 4 or 5 restaurants in every block. They're all gone. I mean, those buildings are empty, absolutely empty. So, in discussing this in spaces, I hear it from other people too. The work from home crowd they're entranced. They're entrenched in to try to work with their employer to work, as many days at home as they can. You avoid the commute. So I think that it's going to be an ongoing problem. Again, I think, based upon what the market action is and what commodities are doing, we're not at levels that reflect a recession at this point in time. So, it's like I say, I think we have to complete that business cycle. And, every day you get more and more information. And it just seems to confirm that at some point we're going to hit having something lever to break.
Yeah, just one anecdote on real estate that I would offer up. I live in Westchester County in the New York City area, and I can tell you from firsthand experience the excess of people leaving the city, coming out to Westchester. Um, it's still making for, this is one of the wealthier communities in Westchester County. There's virtually no inventory, and so a lot of times you'll hear real estate agents say, "Oh, there's no inventory. If we had more to sell, we could do a lot more transactions." It sounds kind of self-serving, but I can tell you, it's actually true. Stuff comes on the market now. The selling season kind of tends to start right after a Super Bowl weekend. I mean, it's unbelievable, the sort of pent up demand. It's just, even in this community, I guess, which is less credit sensitive because mortgage rates have gone up so much. There's just there's still a steady excess of people leaving the city, and I'm sure, Neely, demographic question for you. I'm sure we've read all the same articles. You must have some thoughts about this, but you look at, and you'll correct me on the numbers. You look at states like New York, the tri-state area, New York, New Jersey, Connecticut. Then you look at Illinois, and you look at the loss of population, the gross income that's just walked out and gone to Texas, Florida, and elsewhere. I mean, so I know when we speak in aggregates, we talk about consumer spending, but when you look across regions, are there big differences in consumption patterns from state to state, Neely?
There's always going to be differences, George. I don't have anything specifically to add of value to that point. It's a good point to have. We're actually a little bit more in the near term, team undecided to bearish because of the student loan issue. And if you, it's astonishing to me actually how much I think FinTwit doesn't really appreciate how, like, the 40 million people who aren't paying on their student loans sincerely believe they will never have to pay again. And that's the thing that scares the bejesus out of me. Because I think it's very plausible that that's going to very much go into repayment. I mean, even the president himself has indicated that he is out of options if it doesn't win in SCOTUS, right? They might have repayment plans that they can do, but we're going back into repayment. So there's a couple things that happen when that happens. There will be a 60-day grace period after the announcement, is what the Supreme Court has indicated, and that is, let's just play devil's advocates, mid-June. So you'll be in repayment by August. However, the payment processors will probably have the send button ready to go, right? Because they haven't been paid for 3 years, right? I mean, they're ready to process these payments. And they'll make some indications about that. So the consumer's reality from the announcement to the notification, I think, will have its own economic kind of shock before you even get to the repayment. The other thing that goes into effect, and I think people don't really appreciate that, and you can see this in some of the New York Fed data around credit scoring, is that credit scores hyped up, they jumped up. And in part, it's because all of a sudden 40 million households, or 43 million households actually, didn't have to show student loans as part of their credit reporting. And so that is also another concern that we have, is, all of this debt just all of a sudden goes back on to people's, credit reports and what have you. So will they have access to the same lending that they'll need, at that time when they want to either buy, best case scenario, or when they need to refinance, worst case scenario? I don't know. But to gain a little bit more insight on the information flow, we did put up in the Nest a couple things. One is just a reminder that the quarterly banking profile for the FDIC, it's an often overlooked report. That will be out probably, it's supposed to be out tomorrow. That would be post 55 days after December 31. But maybe it's next week. I don't know. Some of these things have been a little bit more delayed. But that's something to be watching for in terms of what's the health of banks' assets and loans, heading into that season as well.
And Neely, can you just remind us, when is this student loan thing supposed to get sorted out? When's there supposed to be a SCOTUS decision?
SCOTUS will hear arguments on Tuesday. I believe you can actually dial in and listen to those arguments. If not, they'll be posted later that day. So you can listen to the arguments. Of course, no one but the 9 are invited into chambers. So we actually don't know what's discussed, right? Only what's asked during those public arguments. For what it's worth, there's already rumblings of making this a highly politicized event. I mean, I've seen some announcements out there like Elizabeth Warren is rallying people to start protesting on day of, there's going to be a lot of politician talk in the news cycle, I would suspect, on Tuesday. They then go, and they deliberate, right? Not necessarily the same day. They kind of work on these things throughout the session, the season. And then they put out the pronouncements typically in June, and they pace them. You really don't know which day will release which announcement is how it works with SCOTUS. I think off the top of my head, they have probably 8,000 plus cases that audition for their attention, and they only listen to 80 to 100. This is one that's being heard on an emergency basis. So, does that mean they'll be released on an earlier basis? I have no clue. I'm sure someone on Twitter knows this answer.
But we'll get an answer on this.
June. Very likely June.
Okay, then you implement it. And the betting is that this will not be extended. There, people have to start repaying.
Yeah, mainly because the lower court has already ruled that it's unconstitutional to apply the HEROES Act for the forgiveness plan. And so it's not really SCOTUS deciding it per se. It's SCOTUS deciding, is there standing? Again, I have this up in a tweet. I'll put it up in the nest. There's 2 questions being posed. Like, is there standing? And then, is the act to apply this HEROES Act to forgiveness? I forget all the legal terms, but one of them is capricious. So, is it an overextend? Is it statutory? Is it capricious? Like, there's some legal language around it, but I'll put it up in the nest.
Thanks for that, Neely. Okay, with that, let's go to my friend O'Hare. We haven't spoken for a while. Good to see you, O'Hare. What's on your mind, man? How you been? Please unmute yourself, O'Hare.
What's going on, guys? I'm just sitting here on a treadmill listening to your conversation here. So I saw you had requested for me to come up, and I'm ready and willing.
Share your wisdom. You've always got to say what. I mean, listen, it could be about anything. It could be, the stock, a group, football, whatever you want. Just
largely I agree with what I'm hearing. Yeah. Well, I would say I largely agree with what I'm hearing with David and Neely and yourself and some of the other guests. It is when I say I agree, I think it's a very confusing market. A lot of things going on, a lot of opposing forces. So even for pros like yourself, I mean, this is a very confusing market. And if you're trying to trade this market, it's absolutely a gut wrencher. I mean, as you guys know, it's like a washing machine, right? I mean, very difficult. So, however, that said, I think there's a lot of opportunities if you're looking in the right places. About a month ago, I shared a DM with you, George, on some media names that I thought might be of interest to you. And man, I'll tell you, I was hoping you'd consider them, because that would have really helped a little, quite a bit. I think there's still a lot of move in some of these names. I think energy's still got, a long ways to go. I think there's still a lot of companies in the energy space that just kind of are underneath the surface, overlooked, unloved. And I think if you have a multi-year time frame, a lot of these companies are going to do quite well. We don't need oil. I know there's been a lot of talk about oil going to 200 or oil going to 20. If oil can just stay here, 80 to 100, 110, these companies, many of them are going to do very, very well. So I think the energy thing is still intact. You're going to have bumps along the way. Returns aren't linear. As far as housing, I thought that was interesting what you guys were talking about housing. I was in a space the other day. I was listening to a couple of real estate experts talk about housing, and I met with a client a couple of weeks ago who's a very large real estate investor. And I'm getting kind of opposing, depending on who you talk to with real estate, you get different answers. And I always like to say, I've never met a real estate agent or mortgage broker that told me it wasn't a great time to buy. right? The market could be collapsing. It's a great time to buy. The market could be making new highs. It's a great time to buy. So I usually take it with a grain of salt. One thing I'd say about housing that's really weird right now is you're right. Places where you live, George, places where I live, places many of us live, very nice areas. There's no supply on the market. So there's very little supply. Demand's still relatively robust. So prices are still elevated. The problem's going to be, in my mind, and I had this discussion the other day with somebody on Spaces, is that it's going to be on the margin. So there's this idea that housing isn't going to collapse. It can't collapse. It's everybody's got a 3% mortgage 30 years out, and they're going to stay put. I agree with that notion, but the problem is it's the marginal buyer that's going to dictate prices. So it's the guy that's going to move down the street from you. He's not going to be able, he may not want to buy for X. He may want to buy X minus 10%, X minus 20%. And so I think, you're going to see the marginal buyer dictate price, and I think price is going to come a lot lower for the many reasons we discussed. Higher interest rates, for one. Lending standards are a lot tighter than they have ever been. Two, and prices are still very, very elevated. I mean, even incomes have gone up, but prices are still way beyond where they should be. On a large, regional markets are going to be regional markets. If you're in Beverly Hills, if you're in Westchester County, if you're in Marin County, it's a different dynamic. But by and large, in most places around the country, I think you're going to see prices come down, and it's going to be the marginal buyer kind of on the periphery that's going to drive those prices. So, I still think real estate, look at commercial properties. I don't know about New York. I haven't been in New York in a little bit here, but San Francisco, Los Angeles, Seattle, the West Coast. I have a lot of friends and family and clients that are in the commercial real estate market, and I'll tell you, it's not good. I think David or Neely pointed out, there's some defaults happening kind of underneath the surface. I think that's going to accelerate. So, look, I as you know, George, I want to be optimistic. I think there's going to be some opportunities. Although I agree with the Bears to some extent. I think it's going to be rough sledding. So it's just a very strange market. It's I don't expect a gigantic air pocket. I think everybody that's waiting for that, I think they're probably going to be surprised that that's not going to happen. That doesn't mean that we can't be down 20% at the end of the year. That could happen. If that were to happen, I think there's still a lot of opportunities in very beaten down, undervalued sectors. And then within the sectors, subsectors, a lot of companies are out there still generating a lot of cash flows, pay down debt, are positioned to do well even in a recession. Notwithstanding a really deep, prolonged one. So that's kind of my view.
Here, let me ask you this question, similar to what I asked Dave Nicoski earlier, and that is, regardless of your view, how would you characterize the opportunity set right now? Is it wide? Is it narrow? And then secondly, is your conviction level around your ideas higher or lower than it usually is? In other words, a lot of time, a lot of time there's a lot of wood to chop. Sometimes not so much wood to chop. How would you characterize it now?
I would characterize the first part of your question. I would characterize as the opportunity set is actually gotten wider for us. Mainly because now we're starting to see the part of the market that we were not involved in for a long time, mainly the tech, financials, some discretionary, have started to kind of come down to levels that when we run our screens, we're starting to see, based on the factors that we use, starting to see more of these companies that were well outside of our purview now starting to come into our screens. That they're not ready yet, but they're starting to come into our screens. The first and second levels of our screening process. So I think the opportunity set is now getting a little bit wider. It was very narrow for a long time. It was very difficult as a value investor, as you know. And so it's in the last year, and I've been talking about this for well over a year now in spaces with you, George. There's, the growth to value trade is happening. It's been happening for a year now. It's happening right before our very eyes. The problem is most people are focused on the shiny object. They're focused on you guys mentioned NVIDIA's, the car company that shall not be named. some of these ETF strategies. I think I've talked about this idea of passive investing for many years with clients and on Spaces and on Twitter. And I think that this passive investment boom that we've had for well over, 10 years, and it's really been over 20 years, but 10 years really in earnest. I think that those days are going to be behind us. I think we're starting to see institutions, for example, start to warm up to the idea of active again, which we hadn't seen for a very long time. So, I think, we want to be optimistic. I think this is what's going to happen in my mind. I mean, if the market does hit an air pocket and we do, let's say, go down, the NASDAQ was down, 30% last year. S&P was down close to 20. The Russell Midcap Value, which is our index, was down 12. So, if we get another follow-on sell going into this year, which would be unusual, right? Back-to-back down years. But let's say that happens. Let's say you get the NASDAQ down another 15%, S&P down another 10. There'll still be a lot of opportunities underneath the surface because the markets, the indices are still very top heavy, right? You got the Apples, the Googles, the Microsofts, the Nvidias, all that stuff is really, the indices are still very top heavy. You're starting to see some dispersion underneath the water here, which is where the value is going to be created, as you know. So I want to be constructive, but I'm not a Pollyanna. I think if we do get a pretty significant kind of a swoosh down, it'll be a relative game. It'll be the relative game, meaning that value I think will outperform even if it's down. So that's really. But on the converse is if we do have a positive year, in which case we very well may. I mean, the economy is still, I don't know where I am. I mean, it's still, to Neely's point, people are going out. I'm just telling you guys right now. I go to the movie theater. My wife and I just went to the mall. We drove up to Sacramento the other day. It's booming. It's literally people out and about, people shopping, people. Now, could that end? Absolutely, right? I mean, I remember George, and I think and David and Neely, you guys remember up until 2008, right? 2008, the spring of '08, things were still good, right? Everybody was still like, hey, it's okay. This housing thing's going to blow over. Bernanke was saying there's not going to be any issues. I mean, just literally 6 months before, Armageddon, people were still very optimistic. So I'm not, like I said, I'm not, I was born at night, but not last night. I'm not wet behind the ears. I understand that, there could be some tough sledding ahead, but again, I'm not going to be positioned for that. I'm going to be positioned for more of a relative game as opposed to an absolute game in this market right now.
Very well said, O'Hare. If you can hang in there, that'd be great. I'm sure you probably get some questions here. So that appreciate your wisdom. Yes. So, hey, Rob, welcome. Good to see you. Haven't spoken to you for a while. What's on your mind, Rob? You there?
I'm there, George.
We
Can you
got
hear me?
What's going on, man?
Well, as somebody who spent most of the first 30 years of their life growing up in Westchester, I welcome you to the region if you've just gotten there, or if you've not, I hope you're enjoying it as much as I did. Funny, I got fortunate enough to invited to a sell side dinner last week, a strategy and macro firm. And number one, everybody there was as confused as a lot of people on this call are admitting to. So it's pretty prevalent out there. Number two, the strategist and the salesperson that were at the dinner admitted that for the first time in their careers, which were at about 20 to 25 years, they were purchasing bonds. So these things hit me earlier from the call. But one of the things the strategist said was sort of about, this year lacks some sort of big bet for people to make in the market. And to me, big bets are always obvious in retrospect, unless you are the one who gets them right and are in early. But his point was last year, you're long energy, you're short technology, you're printing money, and you had a historic year. And it got me thinking. I think, from where I look at things, where stocks are and where bonds are, they can't both be right. One of them's wrong. And I guess where it always leads me back to is inflation. I've really been digging this over the last 1 to 2 years to better understand it. And credit to, I think it was Peter Bukvar. I had a presentation of his from last year. And sort of for the decade leading into last year, we had a bifurcated inflation backdrop where you had goods were kind of at a 0 to 1% CAGR on inflation. You had the offshoring, the Chinese effect. You had cycles certainly with raw materials, whether it be oil or copper, but they were mean reverting over that phase. But under that, under the covers there, you had services inflation that regularly was registering 2 to 3%. And something that I came out of the COVID lockdown era thinking was, being an analyst who looks at materials and things of that nature. I may have said before, you look at relative supply and demand and what is happening to the supply side. And I thought one of the big things that COVID did, especially for small businesses that are generally involved in the services economy, was wipe out a lot of supply. Of course, we saw some of the larger corporate entities do much better, Home Depot, Lowe's, but the small hardware store may not have made it. So now you're coming back where people have the wherewithal from jobs and from other reasons to be able to spend. There is your sort of handoff to inflation, where here's the irony. People who said inflation was transitory might have had it right in goods. Those are sort of mean reverting, where you get to elasticities where if a good just gets too expensive and it's discretionary, that purchase will be deferred. The market will self-correct. But here we are in services, and Dave said something about restaurants, and he was walking through town and saw it was empty. You would think, I pulled up the chart from the St. Louis Fed. I just Googled, outside of the home food inflation in the New York market. And I encourage you to look it up, because all of a sudden, there's a long-term trend certainly up, but it's pretty gradual. It's just hooked. Not quite hockey stick, but it's accelerated. So my point bringing this all around is, I think that the geniuses are going to be right about inflation being transitory. I just think they're going to be right about it being in goods, where I think services has taken the baton, and we're already seeing it. If you look at the data and you kind of pull it apart. So back to my thing, I think either the Fed's going to have to push rates higher or do something with the balance sheet to influence the long end. So in that case, bonds are wrong. And certainly if that's the case, the stock market, which kind of has been underpinned by this belief of a pivot, so they can't both be right, in my opinion. So just wanted to share those thoughts.
Thanks so much. That was really, really, really interesting. That's terrific. All right, let's go to Storm. Storm, welcome. What's on your mind? Storm, please unmute yourself. I don't know. Maybe you should. You might have to go out and come back in, because we maybe you can hear us. We can't hear you. Say, Rob, are you still there, Rob?
Yeah, I'm still
so
here.
You mentioned that you lived for a long time in the New York City area. Is that still the case?
No, I'm a fortunate resident of the Commonwealth of Pennsylvania.
Got it.
Now.
And because I spent some time in Philly. Are you in the Philly area by chance?
Oh yeah, 45 minutes out west, just a little out off the main line.
Are there any interesting with the trends you were citing? I presume those are local to your area. Is there anything particularly noteworthy about where you are that others not living there might not fully appreciate?
Oh boy, you put me on the spot. That's a good question. No, but I'll give you another anecdote. And people were talking about offices being kind of challenged. I spoke to my insurance guy today. I moved to Pennsylvania from Maryland for a job relocation, but he's still down there in the sort of Baltimore County area. And he's lucky enough to have an office up in the county and one in the city of Baltimore. He was working remotely from home today. He might go to his office in Hunt Valley, which is the suburb there, once a week, but he hasn't been to his office in Baltimore in months. So that was another thing that brought up there's an amount of jingle mail that's about to come in a different form. As you said, history never repeats, but it rhymes. Whereas jingle mail post Great Financial Crisis was
Hey,
residential.
Rob, maybe everyone in this room knows what jingle mail is. I don't.
Yeah.
What are you referring to?
Oh, I'm just the keys are going to be coming from commercial office, not from residential this time. So, and it leads you to sort of think of. I didn't get into it. My insurance guy, he works for a large national firm, not publicly traded, but I remember at one point his sell point to me about the stability of the dividends because it's mutually owned. Very diversified investment portfolio, including real estate. So it leaves me with a follow up to speak to my insurance company. And when you think about that, where are pensions invested, where they thought for 20 to 30 years? Look at REITs or even just MBS, where the virtual cycle of you had rent increasing over time and you had refinancing every several years of lowering the cost of debt. Uh, those two lines seem likely to cross here at some point. The CMBS market seems challenged from some of the things recently I've said about refinancing. And as far as the ability to get rent in the office side of the business, that clearly is going to be a challenge, even to maintain vacancy if something doesn't change for the different from the recent trends. I was just
Church.
reading New.
Sorry, go ahead.
No, just that New York City, they might be back to 50% people are in the office. Nice little nugget came out that the city itself in economic activity has lost $12 billion. I believe it was just last year in economic activity from the difference in pre-COVID uh, office activity, or at least presence, versus now with the work from home disparity. And also, George, no secret, New York is certainly losing businesses. It's just a very easy decision to move to a different locale, given differences in taxes, differences in cost of living, and the great thing about technology and things like Zoom or Microsoft, you can do business from many different places in the country with ease of a push of a button versus needing necessarily face-to-face contact these days.
Yeah, you just saw California came out with their budget deficit of 22 billion. They saw 10 billion less in tax receipts. So if that's not pointing to something that's troublesome about the movement of people out of New York, California, some of those states to Texas and Florida. So kind of interesting.
I was just going to weigh in on one little point here on the real estate side. We are hearing and seeing of these conversations because, I think some people are like, everything's clear, right? And it's like, no, leases aren't up yet, right? So like as leases come due on these commercial properties, it's our sense that a whole host of things are being contemplated, from physical space needs as well as from a human capital needs. I mean, it's interesting you brought up that point around services broadly, Rob, because I think you're right. I think it's been sticky. And I think people forget that CFOs manage to dollars, they don't manage to headcount. And I think there's all sorts of things being discussed around task flow automations. I'm not an NVIDIA apologist. I'm not trying to, jump on that train per se. But the topic of AI is in boardrooms. And boards are who make the decisions about headcounts. And I think that's the thing that might be missed is, jobs seems pretty stable right now, but what's going to happen as people rethink their spaces, they rethink their task flows, they rethink their needs from a human capital perspective. I think you're going to see this kind of drip, drip, drip of attrition.
Interesting. All right, Storm, you're back. Can you hear us, my friend?
Yeah, I apologize. A phone call came in and messed up my audio. I had a question for the respectable speaker panel. What happened in Ohio, Norfolk's Southern, ticker NSC, and what their thoughts were. That was my question.
I don't know that I don't know if we have any railroad experts up here, but I'm sure Dave can speak to the NSC chart as well as the railroad group. Dave?
Yeah, the chart's not good looking, but I will say railroads are not going anywhere. We're still going to use them. There's if you look back over the course of, I think it's like 20 years, you have 1,704 derailments on average. I think the last 10 years it's been like 1,000. So, it's normal, and we're just seeing all of this, and everyone gets worked up. What I will say is, yeah, they'll probably end up spending a lot of money to clean this up, but you know what? In the end, they're going to spend more money to fix everything and try to make things safer, but they just pass that on. This is like, I always tell people, you buy insurance companies a month after a storm. I mean, after 9/11, we published a piece. The market was closed for, a period of like 6 days. We said, wait 2 weeks, buy the insurance companies, because guess what? They jack their rates up for everyone. And you're going to see the same thing. You're going to see them start to charge more, because I can tell you right now, rails are by far actually safer than trucks on the road. Okay. And so at the end of this, to me, it's an opportunity. I don't think rails are going to stop shipping anything. We canceled pipelines to ship oil by rails, and the government's not going to backtrack on it, or this administration. So I think it's like something that you get an opportunity to enter a good company at a reasonable price. And it's sad what happened. It's sad what's going on. I realize that. I'm not trying to, make this all about money and the concerns of the health of people. On another note, I was talking about engineering and construction. I'm going through charts right now while we were talking. And, one of the names that I've mentioned in a number of rooms has been MCOR. I mean, it was up 10.6% today, up $15.58. All of the other engineering and construction companies are doing the same thing. This might be that, outsourcing, you're moving companies out of China into Indonesia, India. I think a lot of these companies have some international business, as well as moving things to onshoring, which is going to take a lot of capital to, build a plant to reduce the dependency in the future. So you're going to, you're seeing companies, even going to Mexico, but MCOR, MYRG, there's a lot within the area in industrial manufacturing for electrical, plumbing, water systems that are absolutely going bonkers, and no one's paying attention to them. So,
by the way, Dave's very modest, but for those of you, and he's so generous with his time and his insights. For those that are interested, Dave's firm, Vermilion Research, they serve some of the biggest institutions in the country, as well as I believe, Dave, you have some individual investors as well as clients, and so I'm sure if anyone's interested, please reach out to Dave. He's on Twitter. Also, is it vermilionresearch.com, Dave? Is that what people can find?
It's vermilioncap.com is our website, and you can
vermilioncap.com with one L, vermilioncap.com. That's terrific. And again, the thing I like about Dave's work, he's mentioned many times, he's a big relative strength guy. So, relative strength and the leadership of the market can always tell you a lot about what's really going on inside the market. But one last question, Dave, I was going to have for you. We've talked about this in the past, but we haven't touched on it in this space. When you look at the U.S. market compared to other markets globally, because I know you follow all the major global markets, any observations, or does it really get down to sectors and stocks?
Yeah, I mean, believe it or not, Europe is doing absolutely fine and doing better than the U.S. The EFA, MSCI EFA index is looks much better and is outperforming on a relative basis versus a lot of the emerging countries. We still like emerging countries, but it's picking them one by one. And at this point, I do believe they made their ultimate bottoms and are coming off of what I would say are secular lows. I do believe the dollar is probably going to strengthen a little, marginally. Could retrace up to 50% of this latest move, which wouldn't be good for our markets, wouldn't be good for their markets. But in the end, I do think there's a secular turn to, emerging markets. You're breaking 12, 13-year relative strength downtrends. That's, the longer the downtrend that's being violated, the more significant it is. So, I'm still looking at Korea. Korea's pulled back nicely to an area which I think looks very good. And there, there's a few other ones that we're actually publishing right now. So I don't have all the info sitting in front of me as my coworkers are helping produce that right now.
Terrific. All right. We've been going at it for an hour and 45 minutes. This has been great. Dave, I want to thank you for all your insights and being so generous with your time. Neely, O'Hare, Michael, Rob, everyone who's been in this space. This has been great. We'll do our next space before too long. And again, thank you, Dave, so much for doing this. I know it goes without saying, everyone really appreciates all that you do. Thank you.
Yeah. Thank you, Neely and O'Hare, and you too, George. You have an awesome day and a great weekend. Okay.
Take care. Good night, everyone.
Thank you.
George.
Bye
Take it
bye.
easy, guys.
Bye. Bye bye. Take care. Bye. Bye. Bye.